Hey everyone, welcome. Good to see you guys. I hope you had a great Friday, a great week. Actually, in across my services, it was an excellent week. I just had someone at the pub ask for a recap of everything that went on across the services, and I didn't even realize. As I was compiling everything, was pretty pretty pleased with our performance this week. Also, is pretty active and busy, so I'm a little tired, but I'm gonna do my best for you guys today. And we will continue with the portfolio management that we started out with 2 days ago. I apologize about yesterday. The publisher had me on a bunch of shows, sort of last minute, and it bled on. I was nonstop on webinars from basically 12 Eastern all the way to 6:30 Eastern. Without any breaks, and obviously it overlapped with the post-market review. So apologize for not being here yesterday. Hey Peter, hey Kay, good to see you guys. So SPY, another all-time high in terms of the high, not in terms of the close. We did close a little bit lower, or actually down 0.01 versus yesterday. So basically, very flat versus yesterday. And you can see that the moving averages continued to move up, so it doesn't look as overextended as we looked yesterday. So things are overall in very good shape for the S&P, and there's no reason to be bearish about it. We could have opinions that maybe we need to pull back and whatnot, but right now everything is looking great, even for the immediate 1 or 2 days or next week or so. So I remain bullish inside of this market. Today, when we look at the gamma levels, 0 DTE, let's see. Okay, I need to understand something. Did the Iron Condor you sent out, TOS assigned me on part of it and I lost? If you got assigned, you haven't lost. You can just exercise the rest of it. So go ahead and put in your, so if you didn't get auto exercised, you should be able to exercise everything, or everything will settle. Everything will settle worth. By the time everything settles, you'll have made money. You won't have lost. Okay. And if you want to go over specifically the math, I can go over the math with you. Just email me all the details of your trade, and I'll go over with you one on one. Hey, Spider Monkey, passively listening while walking. Okay, great. Hope you have a good walk. Hey, Philip, good to see you. So in the channel, I was showing you guys this morning the gamma levels. And over here, we saw that the SPY was split between 670, 672, but the SPX wasn't really all that helpful. And I made the comment that, hey, I'm leaning more towards 670, but if I traded anything, I would encompass 670 and 672 inside of my profit. And I figured maybe I'll go over a little bit out how that might have been done, although it's going to be a little difficult because now all the levels are completely different, but I can show you in principle. And then it turned out that my feeling of 670 was right, because by an hour before the close, we saw exposure all clustered at 670 and 67.25 on the SPX. And at an hour before the close, right here, we were just chopping sideways right around 670. And so half an hour in, I decided, hey, maybe I'll do a 0 DT trade into the close today, but I don't want to count on pinning at exact price. So I looked for a trade that would span a reasonable range. So I broke even between 670.89 and 669.11. And then of course a 1-to-1 reward risk ratio all the way out to here, 668.22 and 671.79. So you can see that that was a reasonable rate. My 1-to-1 reward risk ratio range was all the way at the lows of the day and pretty far up there in terms of the highs. It's really unlikely that would have gone up over here. And you can see in the last 5 minutes, it did break below my break-even range, but it closed inside of it. And so we did close out with a small profit of about a little over 3% versus the capital that was invested. That capital was never entirely at risk because, like I said, over here was a 1-to-1 reward risk ratio. So for us to have lost all that capital, there's way out here. It's very extremely almost impossible for us to actually have lost all of that capital, but it did require that capital to actually get into the trade. And so we always calculate the return off of the capital that was invested. So it was only ended up being a little over 3%, but I'm not going to complain. We were only in the trade for a half an hour. So that ended up being pretty good, and it did pretty much pin reasonably close to 670. So those gamma levels are very helpful. I have people asking me pretty much all the time, am I going to give trades? Am I going to give a service to 0DT, day trading, things like that? My 100% full disclosure and full transparency answer is I just don't have enough time to watch over 0DT trades. My day is completely occupied with my other services, and so I can't put on additional risk on top of that and do a day trading service justice and all the other services justice. So until I get an assistant or two on board, then that's not really in the works. Maybe someday in the future. Let's see. I need your email again. Okay. Yeah, no worries. So it's kane@investpub.com. Okay. There you go. Okay. Hey, Lise. Good to see you. Looking forward to continuing the conversation about managing a smaller account from Wednesday. Yeah, we'll get to that shortly. Okay, so I guess maybe we'll get to that now, and then maybe you guys are less interested in how than the trade construction. So we'll get to that now. Let's see if I still have that document. Yeah. Okay, so we had this document from Wednesday. We talked about the 10 positions max at a time. We talked about max 5 long, max 5 short, and these are the scores that we, and so each long position is worth 1 point, and each short position is worth -1 point. So if I have 1 long, 1 short, 1 plus -1 equals 0. I'm neutral. Not neutral. And if I have, I could be mildly bullish and only have 1 long on, or I could have 2 longs, 1 short, or 3 longs, 2 shorts, or 4 longs, 3 shorts, or 5 longs and 4 shorts, and I would all be net mildly bullish in my portfolio. Now, when we get to these bigger number, or so for 2, for example, let me see, how would this work? Yeah, I guess that would be it. Okay, so if I get to say 3, we might say, oh, I could have 6 longs and 3 shorts, and you would be a 3. And that is technically okay, but you would be kind of violating this max 5 long positions. And you would only do that if you really wanted a large amount of your capital allocated, because at that point in time, 90% of your portfolio is in the market in a position. So you want to make sure you feel very strongly about all the positions if you're going to put 90% of all your money to work. So that goes back to our conversation where I said you want to be in love with, super excited with every single position that you put on. You're not just putting them on just to put on, okay? So this is how we're scoring our portfolio, how bullish it is or how bearish it is. Now, what should those positions look like? And there's a few different ways. It really depends on your exact situation. If this is your only capital, you have no other trading accounts, you only have this one portfolio, my recommendation would be that one position is an income position. Okay, and this could be, it doesn't matter, it could be a long or short, doesn't matter, but it's an income position. So if we're talking about my services, that could be morning payout plan or project. I don't remember if we call it plan or project. I always say plan. It could also be the weekend trading club. Those are both income style trades. And if you ever heard me pitch either one of those, I always comment on how I draw directly from my portfolio manager experience, my professional portfolio management, and the importance of having stable returns and stable income inside a portfolio. If you want your equity curve to be as smooth as possible, one of the best and easiest ways is to add income trades. I told you guys, I think on Wednesday, that there's a reason why bonds make up an important part of portfolios, for professional portfolios, especially for retirement funds, especially for insurance funds, and especially for pension funds, because they take out regular withdrawals. And hopefully we can take out regular withdrawals from our trading accounts as well, so that we can actually enjoy the money. It's not just sitting there inside of an account forever and just accumulating, or we're just staring at numbers on a screen. At some point in time, it'd be nice to take some of that money out, especially regularly, in order to improve our lives. So whether that's replacement of income or having extra income or just funding fun little projects, family vacations. I have accounts that serve different purposes. For example, an account that helps pay for a daughter's college, accounts that are specifically there to help pay for car payments, things like that. So you want these steady type of returns and equity curves in order for you to be able to draw on them. Because let's just say, and you don't want it like this either. You might think, a lot of people think that's okay, because what happens is, let's say, some people think about, oh, I have I don't know, let's just say $100,000 account. And let's say I make 10% on it per month, which might sound crazy to some people, but it can be done. If you're doing that, then you're taking out $10,000 per month. Or you're taking out, let's say you want to take out $10,000 per month. So this account has to perform at least 10% per month. So if it does that, then it's going to look like this. That's your equity curve. Perfectly horizontal. If I could draw it perfectly horizontal, and the peak's the exact same. You go up 10%, you take it all out. You go up 10%, you take it all out. And that assumes that you never lose, which is not a good assumption, right? And so you can't do that. It's gotta be able to grow, because sometimes you're going to lose. And so every drawdown that you take, every 10,000 that you take out of that, the way I tell people to think about it is, and the way that I think about it is, every month I'm going to make a trade. And that trade is going to guaranteed be a loser. That's what my withdrawal is. What my $10,000 withdrawal per month is, a guaranteed losing trade. And you might go, well, why would I take that trade? Well, because you want to take that income. You're actually using it for something, right? It's not actually a losing trade. You're taking that out of your account, but to your account, it doesn't know the difference. All it knows is that there's $10,000 less than there was the day before. So to your account, it looks like you have a $10,000 losing trade, and then you have to have your gains at least that same amount in order to break even, and hopefully even more, because if you happen to draw out capital when there is a drawdown in your portfolio, you don't want it to dip too far, because then you're playing catch up, not only for the amount that you withdrew, but the amount that you lost also. And then in order to get yourself back ahead again, you've got to really outperform in the next month. So it is better for the best way to do this, in my mind, the way that I think about it, the best, simplest, easiest way in order to do this is this draw out amount should equal a normal loss. Oh my gosh. I need my pen tablet in the account. Okay. And if we look at this over here, if I'm allocating 500 per position, okay, on a $5,000 account, that is a normal loss. Okay, so that's reasonable. However, it's a guaranteed losing trade. So if whatever systems that I'm trading, if normally I say it's a 70% win rate, I'm going to expect to win 7, lose 3. Okay. Then what I've effectively done is I've changed my expectations to win 6, lose 4. Okay, I've decreased the win rate on my portfolio because I'm taking automatic losers. Those withdrawals count as losses. And therefore, my expectancy, when I go and I get my expectancy, I need to be able to, those expectancies have to add up to at least 10% of my portfolio, given the number of trades I plan to take in each month. Otherwise, and that's just to break even. That's just to keep it flat. Okay? So the math, the things that we're starting to track here are starting to get a little bit more and slightly more complicated, but I think you should still be able to follow along so far. Okay. So basically what we're saying here is my account, if I plan to take 10% of my account every month, so assuming I want to withdraw 10% of my account per month, then I need to grow my account by at least 10% per month. Therefore, I need a system and enough trades in that system that could return an expectancy of at least 10% per month. And actually you would want more than that, because in the case that on certain months it doesn't return that 10%, you can make up. It doesn't put you too far down. It make it hard for you to recover. Okay. So how does that math look? How does that work out? Okay. Let's assume that you're only trading one system, because that's going to make this easier. So ignore this for now. We'll make our life easy, and then we can make it a little bit more complicated after we understand this. So assume trading only one system. That system has a 70% win rate. Okay. And then we need to figure out what our net winners and our average winner and our average loser is. So let's just say our average win is 30%. Average loss is 20%. That's a good 1.5 to 1. Now, if you're taking 2 to 1 reward risk ratio trades on the underlying, then on the option, you're probably getting closer to 1.5 to 1. And if you're taking 1.5 to 1 reward risk ratio trades on the underlying, then you're performing probably about a 1 or 1.1 to 1 reward risk ratio on the option, okay, on a short term system. It's a little bit worse on longer term systems, okay? So you lose some of that reward risk ratio because then that's the cost of leverage. So basically we're going into the options market to leverage our money so we can get really large percent returns. And we don't have to invest as much capital in order to get the same dollar return. But the cost of that is we get inefficiency in our reward to risk ratios. And I showed you that last week when we were talking about the part of the trading plan, the planning out the risk in the part of the trading plan, right? So that's why we like to look for 2 to 1 reward risk ratio trades. Because if I go down here, just say for me to lose 100% of my option, the price has to move less downward than it has to move upwards in order to make 100% on my option. Okay, so it's harder for me to make 100% than it is for me to lose 100%. Right? That's what we're saying here. And so we want at least a 1.5 to 1 when we're trading options. Okay. Everyone following me so far? Is there a correlation between gamma pockets and a volume profile indicator, especially a 0 DTE? Definitely not causation. Is there a correlation? There can be if the market maker is heavily involved. Yeah, because basically they're going to have a large trading volume right around the gamma pocket, but you'll see the gamma pocket before you see the volume profile. Okay. All right, great. So it looks like, hey, John DLR, good to see you. Thank you, TP. All right, glad you're following. All right. Okay. So if this is the case, now what I'm sharing with you is assuming that we're not compounding. Okay, things get a little bit more complicated if we're trying to compound. So expectancy, or actually what we call technically arithmetic expectancy, is for linear trading. And then, why am I blanking? Geometric expectancy is for compounding. Okay, but we're not doing this, and it's actually, it's not that much more complicated, but it is a little bit more complicated calculation to do the geometric. But we're assuming here arithmetic, okay? We're linear trading. We are always putting in $500 per position every time until our account grows to a certain size. Then we choose a different allocation, and then we're always putting that new allocation in, okay, every time, or as close as we practically can to it, within, as close as we can. right? If it ends up being 475, and if we try to add another contract and it ends up being $600, then we're going to put in 475, right? So the arithmetic expectancy is just the win rate times the average win minus the loss rate times the average loss. Okay, so that equals 0.21 minus 0.06 equals 0.15. Okay, so that means we expect each trade over a lot of trades, we can expect that we'll make 15% per trade. When 15%, well, I'm allocating 500 all the time. So it's going to be 15% of 500, which is $75. Okay. So if I want to be able to withdraw, on average, $500 from my account, and that is going to be 5. No, it's going to be one. What am I doing? 6. 6 3/4. Okay. So that means my system has to be able to generate 6.75 trades per month, 7 trades, okay? And I have to have the slots for it inside of my portfolio. So I'm not going to take 7 trades all on one day because one, it would violate my max longs positions. It would mean I'm extremely retardedly, like idiotically bullish on the market. Even if I balance it out with 3 shorts, I would still be hyper bullish in the market. Okay, so I'm not going to do that. And then I would have extreme correlation in the market and extreme correlation on the positions themselves, as we showed last time with a correlation using the stock fetcher. So we're not going to do that. We can't do it. We have to be able to space them out. So what I need to ask myself is, what is the average hold time? Okay. And so assuming that I can have 3 trades on at a time, if I can have 3 trades on at a time, and that puts me maybe in the strongly bullish territory, is it appropriate? Am I strongly bullish right now? And if I did that, then that would give me up to 2 weeks per trade, and then I'd probably be okay. Right? Because I could finish with 3 trades and that in 2 weeks, and then I'd have another 3 trades in 2 weeks, and then I would have 6 trades done. Okay, so some of the trades maybe are a little bit shorter, and so they're, maybe I can squeeze in another trade in there. If I was only bullish, then I would need them to be a little bit shorter. Okay, so basically I would need them to be, if I could only put 2 at a time, then they would have to be 10 days each, a week and a half calendar days, okay, calendar-wise. Does that make sense? So that means I need a short-term trade. And this is why you don't see any of my services with longer hold times. You don't see me issuing 1 or 2 month or 3 month trades. You don't see me issuing verticals with expirations a month out, 2 months out, okay? Unless the expectation is to close them early. But generally, I like to hold my verticals close to expiration. Okay, so all of my systems that I put out for people that I publish are designed specifically with the retail trader in mind, specifically for the smaller portfolio under 10 million. And so that therefore my hold times are always low. My win rates are always reasonably high. I don't have a win rate below 70. I don't have a win rate below 70. Okay. I did that on purpose. I don't go, oh, I think this is a great idea. It's a good system. I just throw it out there. I always keep you guys in mind and your portfolios in mind. And then later on, I'll show you how I also make sure that my systems work in tandem so that if you wanted to build a long short portfolio like this, then they're appropriate for your portfolio. You could end up using all those systems for your portfolio. So this is not willy-nilly. Okay, everything is very, very, very carefully designed. I don't know if other people, I don't think other people do that or even know to do that, but I do it. Okay, so because I'm thinking about what is good for your guys' portfolios. So over here, we want 6.75 trades on average. What that will mean, though, it doesn't mean that we land perfectly 6.75 trades or 7 trades and we make a little over $500 every single month. It doesn't mean that because we have a small number of trades. And we don't necessarily win exactly 70% of the trades when we're talking about only 7 trades or even 10 trades. It doesn't mean, so what I wrote over here, okay, I win 7, I lose 3, that even that doesn't, that's a poor assumption on 10. And this is why in my services, I share with you guys, I always go through an education portion where I go through the win rates. Okay, let me see if I can find win rates. So this is a study on win rates. I programmed this over 1 million assumed trades, winning at 70%. Okay, if I only take a sample of 20 trades, not even 10, it was possible across 1 million trades. It is possible to find 20 trades in which you only won 15% of the time. It's like, that's terrible. But there are also trades where you won every single one of them, or 20 trade sequences where you won every single one of them. Okay, and so that is a large deviation from the 70% of the system. Okay, so that is going to create portfolio volatility. And so, and what I told you guys is that we want to minimize that volatility, right? We want it to look as straight as possible, like this. And then if you're taking 20 samples at a time, it could look very extreme. And maybe the best fit line is also this, but you're deviating very wildly from that line. Okay, and you end up on that line at some point when you're evaluating. So as we continue, I will show you how to minimize this. Okay. But basically, it's not going to happen with just one system unless that system itself is already like this. Okay, which the morning payout plan is. Okay, so which is why a couple days ago when someone asked me if I'm a beginner, which one of your programs would you recommend to start with? A morning payout plan for a large number of reasons. Morning payout plan, but one of them is super easy. One of them is very steady, and you know what to expect in terms of trading. And then number one, it's very steady in terms of its returns. It has minimum drawdowns and minimum surprises. Doesn't really fluctuate all that much. And if we lose, it recovers extremely quickly. And it lends itself, it's like the perfect system for compounding. All the check marks that you want for ideal compounding, it has it in there. And it's super effective at compounding. And so that's why also up here, I was about to start with this. Because as a stable base of building your long short portfolio, but I think we need to talk about this other stuff first. Okay. So over here, what we're saying is that, look, you need, even with 100 samples, okay, there are 50% win rates in sequences of 100. And then there are 85% win rates in sequences of 100. Okay, so you will still get this large fluctuation from your center if everything's completely random. Okay, so basically the way that we're going to minimize the fluctuation across this expectation that we're looking for in our portfolio, the way that we minimize the fluctuation across this is the first way is reduce randomness. Reduce random. Oh gosh, that looks terrible. But so reduce random will reduce that. And the other way that we're going to do it is to introduce more than one system, because the systems aren't going to perform the exact same as long as they operate on a different edge in the markets. And so you might have a system that might look like this. And if you had that and you added those two lines together, you would end up something more like this. Okay. Well, okay. Even better. But you would end up something a lot more smooth. And if you could layer 2 or 3 or 4 systems together like this, then you can get something that is really, really smooth. Okay. So those are the ways. Those are the ways that, and I'll slowly continue with this and explain how that starts to become accomplished. Okay. All right. Let's see what you guys are asking. Going to watch Wednesday and today's show a couple times. Okay, good. All right. So, but we are starting to keep things simpler. We're starting with just one system. Yeah. Now, ideally, I could get in more than 7 trades per month, because on some months I will have underperformance, just like that sheet that I closed and probably shouldn't have. Showed you that on a 20 sample that sometimes you only won 15% of them. Okay, so 15% across 20, so they call that 3 weeks. Your entire month, basically you're down that month. You lost money that month, and then you're going to take your drawdown, your losing drawdown, because remember, we're taking a guaranteed loser, so actually our win rate becomes this. And the unfortunate thing is you'll never have 100% winners because you're guaranteed that one drawdown is a guaranteed loser. Okay, so we are skewing things to the downside by taking that withdrawal. But one rule that you might consider is that if you're having a down month, you don't take the withdrawal. Now, that may or may not work for you because you might need this actually for income. Like if this is your only source of income, then you can't really live by that rule, right? You can't really adopt that rule. But if you have the ability, then I would suggest that if you have a down month, you don't take your withdrawal that month because you don't want to add oil to the fire. You don't want to make it so much more difficult for you to return back to this point. The other thing that you consider is you make that one withdrawal less than your average trade, the loss on your average trade. You make it half of the loss of your average trade. You make it 10% of your average trade. So that means out of my $50,000 portfolio, instead of pulling out $500 a month, I'm going to pull out, well, 50 might sound too low, but like 250 or 200, something less than the normal loss. Yeah. I'm understanding right that we need to take 7 trades to make $500 expected value. That's correct. That's the calculation we did right here. Okay. Assuming that you had a 70% win rate system where the average win is 30% and average loss is 20%, yeah. You would need to take, on average, 7 trades. So ideally what would happen actually is you didn't do it every single month. And then what you would do is you took 7 trades across 12 months, okay? And that means you took out 84 trades, or minimum 84 trades. And that means that you're a lot closer to that 100. So your deviation from the expectation of 70% wins is a lot less. And the expectancy calculation that we did over here is a lot more on point. Okay, and so ideally what would happen is that you took about 84 trades, and on those 84 trades, you made about $75 per trade. Right? So and then at the end of the year, you just take your 6,300 out instead of doing it every single month. That would be better. Okay, that would help a lot. Okay, the more trades I can get in per month, it might feel like that the better, because the faster I can get to that expectation. But that's the same thing that I talked about on Wednesday, where a bunch of people ask me, Kane, can you give us 10, 20, 30 trades every single week? If you want crazy correlation and crazy fluctuation, yeah, I could. And if you don't want me super excited about every single one of them, yeah. But it's probably not going to serve you, right? So you do want to spread the trades across time. You don't want too many trades on in a short period of time. So this is actually pretty good medium. Right? Okay, let's see. So to get $10,000, one would need to take 140. Say this is exactly what we were just talking about, Doveriv. That's exactly what I'm saying. Okay, so if you want $10,000 and you want to make 140 trades, then you're making almost double the number of trades. Okay, so you're probably making 12 trades per month. That's a lot of trades, and that doesn't really fit. If basically in order to do that, you need 2 to 3 day or 4 day average holding times, not 1 to 2 week average holding times. Okay. If you could do that, then sure, but only if the system is designed that way, because otherwise you're either one, over allocating yourself, and taking 4 or 5 or 6 positions at a time in order to get that number of trades. Or you're, I don't know, actually that's about it. Or you're splitting your allocation too small, in which case that's not helping you anyways, okay? So, yeah, so if you want to be able to take $10,000 out of a $50,000 account every single month, you would need that type of system. Yeah. And again, you are going to have draw. It's not going to be so linear. It's not going to be so perfect every single month. You're going to have some really great months and you're going to have some terrible months. And so the more you can stretch out that period of time before you're taking that withdrawal, the more helpful it is going to be to the performance of your portfolio, and the easier it is going to be to keep the portfolio performance active, or active, or performing at the level that it needs to at least maintain itself. Remember, everything that we're doing here is just to make sure that you still have $50,000 after you take your withdrawal. And, or as sure as we can, that you still have $50,000 to make that withdrawal. So if you ever want to see this grow and make it even easier for you to actually make that $10,000 withdrawal, then you wouldn't, right? You wouldn't put that type of pressure on yourself. It would be much better for you to wait till you had a $100,000 account and make that withdrawal, and even better to wait till you have a $200,000 or $250,000. Right? That way, your withdrawal can be less than the average losing position in your trade, in your account. Okay, make sense? If your win rate is not 70%, you may not be taking hyper bullish, etc. trades. If your win rate is not 70%, you may not be taking hyper bullish, etc. trades. This scale is really meant for your portfolio. So if your win rate isn't 70%, you're saying that you would never put on 4 positions or 5 positions? Is that what you're saying, Mark? It's not necessarily the number, whether or not I get crazy bullish or hyper bullish is dependent on the market and not on my system. Okay, so if I have a system that has an edge in the bull markets, then I'm going to use that system in the bull markets. And if that system only wins 40% of the time, but when it wins, I make 200%. And when it loses, I only lose, 50%. Okay, I would still trade that if it was in hyper bullish or crazy bullish. Okay. So are we clear up to this point? As the market is now, where would you land on this scale personally? Bullish. I might be starting to get strongly bullish, but right now I'd be bullish. If you can't find trades that are likely to succeed, less trades may be appropriate. I know why you're saying that, but the likelihood of my trade succeeding is largely dependent on my system. Okay, so if my system provides me with a 40% chance of winning, I'm not going to find a trade using that system that has an 80% chance of winning. Not going to happen, right? It's going to fall within a fairly narrow range of the performance of the system. Or I'm not trading that opportunity the way the system says I should be trading it, in which case I'm not trading the system. And in which case I better be trading a different system. Otherwise I'm gambling because I don't know the odds, the expectancies, and I don't know if they're in my favor. They're not known, they're not calculated. Okay. So the frequency at which I put on trades using that system is actually dependent on the hold time of that system. Because I want to, and it's also going to be dependent on my capital and my average hold, or my average trade size, my normal trade size. If I can hold 10 at a time, or I'm allowing myself only 5 at a time, then I can only hold 5 at a time if I'm crazy, stupid, bullish. So it's not dependent. Everything's going to be dependent on my situation and not just on the trade itself. So I think that's I'm glad you're bringing this up, but I think that's a conception, a misconception that a lot of people have. And it is perpetuated by the traders or the educators or whoever out there who say, oh, I have high conviction on this trade and I am going to put more money on it, right? Yeah. Oh, I have a star rating. This is a 5-star trade. I'm going to put 5 times the amount of money on it. This is a 3-star trade. I'm going to just put 3 times the money on it. This is just a 1-star trade. I'm just going to put one unit, one allocation on it. And that type of methodology is a gambler's mentality. They think that that there's a different set of odds for a different trade when you're using the same system. And it's just not the case. And they think that the odds apply to a single trade when it's not. If that was true, then we wouldn't get the situations like this. Oh, I didn't close it. Oh. We wouldn't get this, where if I had a sample of 20, then I could get 15% win rate or 100% win rate. If it's true that the odds apply to each single trade, then I should never get this. I should get very steady, very consistent. Every 10 trades, I win 7. Every 10 trades, I win 7. Every 10 trades, I win 7. It should be very consistent with very little deviation. But that's never the case in trading. At any one given trade, we don't know the outcome. The outcome is still, we have to treat it still like it's 50-50. And if that's true, I can't say I have high conviction on it. And I can't say I'm going to put 5 times the amount of money on it. Because whether or not this particular trade is a winner is still random. Okay, so basically if I said, here's a basket of 100 trades, which ones are going to be winners and which ones are going to be losers, those are still random. But I can positively expect that roughly 70% of them are going to be winners and 30% of them are going to be losers. Which one specifically is random? But as a whole, as a pool, I can expect roughly 70% of them are going to be winners. Does that make sense? So you can't really do that. I have to treat each trade and I have to allocate my risk and prepare for each trade as if I only have a 50% chance of winning. I'm trading an edge. And so if that's true, I've got to give myself more opportunities to trade. I have to be consistent in my trading because I just need to make sure that I do get up to 100 trades where I've kept the conditions the exact same or as close to the exact same as absolutely possible. That's the whole point of the system. And that way I can be assured that 70% of my trades roughly are going to win. And they're going to win at this percentage. And then the 30% that I lose are going to lose at this percentage. But what any one given one does is a crapshoot. And no one can guarantee that. Anyone can say I have high conviction and be very easily be proven wrong. So we don't want to fall into that trap where yes, we want to be very excited about the trade, but we don't want to get married to the trade. We don't be like, oh, this one's for sure a winner. No, no, it's not. I'm not gonna, even if I had a 99% win rate, I'm not going to bet the house that I live in and the car that I drive and my retirement account on a single trade. We can't be assured that that next one is going to hit. Okay. Okay. Does that make sense? Did I explain that? Well, I think you guys are already telling me. Okay. Good. Okay. We're basically out of time, so it looks like this discussion is going to continue on into next week. But hopefully, you're learning a lot and you're thinking about this differently than you used to now. So, all right. Are there any last minute quick questions that I can answer before we wrap up? Yeah, there's such a big delay. Oh, you're welcome, Melly VFX. Okay, so it doesn't look like we're getting any questions in here. Okay, so we'll wrap this up for the weekend. All right, have a wonderful weekend. Hopefully get some rest. I know I need some rest, and we'll continue this. There's still a lot to learn here, and I think we're making good progress and making some good insights in here. Okay. Thank you much. I'll be back on Monday. Good. I'll look forward to seeing you. You're welcome, John. You have a great weekend as well. Can you post the sheet where we can all see it? This sheet? I can. I don't know how much it's going to help you without the context of me talking about it, but yeah, I can. I have to think about where to post it where everyone can see it. I in the public forum because this is out to YouTube and in the public. Let me figure out how to do that, and I will do that for you guys. Okay. All right. Okay, Kay. I'll take a look at your email and I'll answer. Maybe not today because I'm a little worn out, but sometime over the weekend for sure. All right. Okay. Thank you, George. Thank you. Thank you, Philip. Thank you, Bob, Blaine. Thank you, Mark. Thank you, Steve. Okay. All right. Have a great weekend, and I'll see you guys on Monday.